Most traders don't fail because they lack information. They fail because they spread their attention too thin, their conviction too shallow, and their identity too fragmented. They believe diversification will protect them, but instead it slowly disconnects them from mastery. Today, we are going to solve the quiet problem that destroys more trading accounts than bad entries ever will. The fear of commitment disguised as diversification. In the beginning, diversification feels like maturity. It arrives dressed as wisdom. It speaks the language of responsibility. It whispers that balance is safety, that variety is intelligence, that spreading oneself thin is somehow a sign of growth. More markets, more strategies, more time frames. The trader feels sophisticated, almost evolved. They are no longer reckless, no longer impulsive, no longer emotional. Or at least, that is the story they tell themselves. But beneath this polished surface, something quiet alive, something restless, something anxious, because this stage is not driven by curiosity, it is driven by fear. The trader does not diversify to reduce risk, they diversify to reduce exposure. Exposure is dangerous because exposure reveals. It reveals whether a decision was sound or impulsive, whether a loss was structural or emotional, whether a win was skill or coincidence. So the trader spreads out not capital alone, but responsibility. If one trade fails, another might succeed. If one market disappoints, another can distract. If one strategy collapses, the failure can be emotionally diluted across 10 charts. Nothing lands fully, nothing cuts deeply, nothing teaches honestly. This is the first illusion that safety comes from multiplicity. In reality, multiplicity often becomes anesthesia. Losses do not hurt enough to instruct. Wins do not stay long enough to build trust. Every outcome is softened, blurred, and quickly replaced by the next idea, the next setup, the next promise of redemption. And so learning stalls not because the trader lacks intelligence, but because they lack intimacy. Intimacy with a decision means standing naked in front of it. It means knowing exactly why you entered, why you stayed, why you exited. It means being unable to hide behind another market or another narrative. But intimacy demands courage, because when a trade fails under full focus, there is no escape. No external explanation feels satisfying. No distraction offers comfort. The ego is forced to sit with accountability, and accountability threatens identity. At this stage, the trader's sense of self is still fragile. They need to believe they are competent, adaptive, smart. Diversification protects that image. If something goes wrong, it was not me, it was the market, or volatility, or news, or timing, or just bad luck. And because nothing is owned fully, nothing is learned deeply. This is why, in this stage, losses confuse instead of educate. The trader reviews trades endlessly, yet understands very little. They jump from explanation to explanation, never staying long enough with one truth to let it settle. Every loss has 10 possible reasons, and therefore no real lesson. Wins are equally unhelpful. A winning trade does not build confidence, it dilutes it, because the trader does not know which part of their behavior created the result. Was it the strategy, the market, the time frame, the coincidence? Confidence cannot grow in ambiguity. Trust requires repetition under consistent conditions. But consistency feels dangerous here. Consistency would mean commitment, and commitment would mean exposure. So instead, the trader becomes busy scanning, busy switching, busy optimizing. Busyness becomes proof of seriousness. Movement becomes mistaken for progress, and slowly, a subtle dependency forms. The trader begins to equate stimulation with safety. If they are always engaged, always analyzing, always switching, then they never have to sit with doubt, never have to face boredom, have to confront the possibility that their edge may not exist yet. This stage is loud, charts everywhere, notifications firing, opinions stacking on top of opinions. But internally, there is a quiet emptiness, because deep down, the trader senses it. Nothing they are doing feels grounded. They are surviving but not evolving. This is why stage 1 is so seductive. It allows the trader to feel productive without being vulnerable. It offers motion without depth. It creates the illusion of control while quietly postponing responsibility, and the market allows this illusion for a while. Small wins keep hope alive. Small losses prevent collapse. The account drifts sideways, just stable enough to avoid reckoning, but eventually something cracks. Fatigue sets in, confusion deepens. The trader realizes they are working harder yet understanding less. And that is when the first brutal truth begins to surface, not loudly, not dramatic, but persistently. You cannot master what you refuse to fully face. Mastery requires narrowing. It requires choosing one relationship over many flings, one language instead of 10 accents, one rhythm instead of constant noise. But stage 1 resists this truth. Because narrowing feels like loss. It feels like giving up option. It feels like admitting that all this effort has not yet produced clarity. So many traders stay here for years. They mistake endurance for progress. They confuse complexity with intelligence. They equate diversification with wisdom. But this stage is not wrong, it is necessary. It reveals the trader's relationship with fear, with identity, with accountability. Only when the trader becomes exhausted by avoidance, when distraction no longer comforts, does the door to the next stage begin to open. And that door does not lead to more markets. It leads inward. Stage 2 does not begin with confidence. It begins with exhaustion, not the kind of exhaustion that comes from losing money, but the deeper fatigue that comes from losing meaning. The trader has done everything right, studied more, watched more, added more, and yet nothing feels clearer. This is the moment when complexity stops feeling protective and starts feeling suffocating. The trader begins to sense that the noise is no longer information, it is avoidance. That the endless variety of markets, strategies, and perspectives is not expanding understanding but postponing it. And slowly, reluctantly, a decision is made. They contract. Fewer markets, fewer ideas, fewer explanation. What looks like simplification on the outside feels like grief on the inside, because contraction is not merely technical, it is existential. The trader is not just letting go of charts, they are letting go of identities. I am versatile. I am adaptive. I can trade anything. These beliefs once provided comfort. They made uncertainty feel manageable. They allowed the trader to feel competent even when results were inconsistent. Now, those beliefs must be surrendered, and surrender feels like becoming smaller. In stage 2, every trade becomes louder. There is no secondary market to distract from a mistake. No alternative strategy to soften the blow. If the trade fails, it fails fully. This is the first true confrontation with responsibility. Losses are no longer abstract, they are personal. The trader feels exposed not to the market but to themselves. They can no longer say, this just wasn't my best setup, because this is the setup. They can no longer blame lack of focus, because focus has been chosen. And this is deeply uncomfortable, because focus removes ambiguity. And ambiguity was the ego's refuge. In this stage, boredom appears for the first time, and it is terrifying. The trader sits and waits. They watch price do nothing. They feel time stretch. Without constant stimulation, the mind turns inward. Doubt surfaces. Old insecurities speak louder. Am I actually good at this? What if this edge doesn't work? What if I've misunderstood everything? Stage 2 forces the trader to tolerate silence. Silence between trades. Silence between outcomes. Silence where self-deception used to live. Many traders interpret this discomfort as failure. They believe contraction means regression, that reducing activity is a sign of weakness. So they return to stage 1. They add markets again. They complicate again. They chase movement to escape stillness. But those who stay, who endure this narrowing, begin to change in subtle ways. They start to notice details previously drowned out by noise. The rhythm of price, the emotional texture of entries and exits, the difference between impatience and intuition. Losses begin to hurt more, but they also teach more, because now each loss is specific, repeatable, traceable. The trader can no longer hide from patterns in their own behavior. They see where they hesitate, where they rush, where fear overrides logic. This stage demands emotional honesty, not confidence, not optimism, honesty. It asks the trader to admit that discipline is not a trait, it is a skill learned through discomfort. That patience is not passive, it is active restraint. That waiting is not absence of action, it is action itself. And here lies the most painful aspect of stage 2. Progress becomes invisible. There are fewer trades to celebrate, fewer moments of excitement, less external validation. Improvement happens internally, quietly, slowly, without applause. This is where many traders feel alone. Friends don't understand why they trade less. Mentors don't always validate the choice. The trader questions whether they are still moving forward. But something profound is happening. For the first time, the trader begins to separate self-worth from activity. They start to understand that restraint is not fear, it is respect for risk. That selectivity is not hesitation, it is clarity forming. Stage 2 is where emotional maturity is forged. It is not glamorous. It does not feel empowering. It feels humbling, because humility is the cost of precision. The trader learns to sit with loss without self-attack, to sit with waiting without anxiety, to sit with uncertainty without escaping, and slowly, almost imperceptibly, a new identity begins to emerge. Not the trader who knows everything, but the trader who knows one thing deeply. This is the turning point, because once a trader accepts contraction not as punishment, but as refinement, the chaos loses its grip. The market stops feeling overwhelming. The process starts to feel grounded, and the trader, though still uncomfortable, is no longer lost. Stage 2 does not reward quickly. It reshapes quietly, and only those willing to lose who they thought they were can discover who they are becoming. Stage 3 does not announce itself. There is no dramatic breakthrough, no sudden surge of confidence, no moment where the trader feels victorious. Instead, it arrives quietly, almost invisibly, after the noise has been stripped away. The trader is no longer searching. This is the first and most important shift. In the earlier stages, searching was constant. Searching for better indicators, better entries, better confirmations, better explanations. Searching felt productive. It gave movement to uncertainty. But now, something has changed. The trader begins to recognize rather than predict. They stop asking what could happen and start noticing this is familiar. Patterns no longer feel theoretical. They feel relational. The trader has seen this behavior before. Not once or twice, but dozens of times, under similar conditions. They remember how price slowed, where volatility contracted, how momentum hesitated. This familiarity is not intellectual, it is embodied. It lives in timing, in restraint, in the calmness of execution. And with it comes a new kind of intimacy. Intimacy with one edge means knowing its temperament, its strengths, its vulnerabilities. The trader understands when it thrives and when it should be left alone. They no longer force trades to make the market fit the strategy. They wait for alignment. Waiting no longer feels like deprivation. It feels like respect. In this stage, the relationship with risk transforms. Risk is no longer something to be avoided or feared. It is something to be measured, contained, and accepted. The trader no longer seeks certainty. They seek clarity. They know that every trade contains uncertainty. But they also know that their process has been tested, repeated, and survived. This changes how losses are experienced. Losses still happen, but they do not destabilize identity. They are absorbed, analyzed, and released. There is no emotional draw, no need for revenge, no urgent attempt to fix the account. Because the trader is no longer trading outcomes, they are trading process. This is where discipline stops being forced and starts becoming natural. In earlier stages, discipline felt like restriction, like suppression, like denial of impulse. Now, discipline feels like alignment. The trader does not need to fight temptation, they rarely feel it. They do not need rules to prevent chaos, clarity already has. And something unexpected emerges here, calm confidence. Not the loud, performative confidence of prediction, but a quiet trust built through repetition. The trader trusts themselves not because they are always right, but because they know exactly what they are doing. Execution becomes almost ritualistic. The same preparation, the same criteria, the same sizing, the same exits. This repetition does not feel boring, it feels stabilizing. Because in repetition, the trader discovers freedom. Freedom from second-guessing. Freedom from emotional whiplash. Freedom from the need to prove everything. In stage 3, the market is no longer an adversary. It is no longer something to conquer, outsmart, or dominate. It becomes a conversation. The trader listens more than they speak. They respond rather than react. When conditions are wrong, they step back without resentment. When conditions align, they engage without hesitation. This balance between patience and decisiveness is the hallmark of intimacy. The trader is no longer obsessed with being active. They are committed to being precise, and precision requires restraint. In this stage, the trader trades less but sees more. They notice how their emotional state affects perception. They recognize when excitement clouds judgment. They respect when fatigue dulls awareness. Self-regulation becomes as important as market analysis. This is a crucial evolution because now the trader understands that their edge is not only technical, it is psychological. Their ability to stay present, to remain patient, to act only when alignment exists. This is why stage 3 feels stable, not because losses disappear, but because chaos does. The trader is no longer pulled in 10 directions. They are anchored. They accept that mastery does not come from expansion, but from depth. That power does not come from options, but from commitment. And with this acceptance, a new identity solidifies. Not the trader who knows everything, not the trader who trades everything, but the trader who knows exactly when to act and when not to. This identity is quiet. It does not seek validation. It does not chase novelty. It values consistency over excitement, process over performance, longevity over intensity. Stage 3 is where trading becomes sustainable, emotionally, mentally, professionally. The trader no longer needs to escape discomfort because discomfort no longer defines them. They have built a relationship with uncertainty, a respectful, honest, functional relationship. And like all deep relationships, it is not dramatic. It is dependable, and that is its greatest strength. The final stage does not feel like victory. There is no rush, no surge of adrenaline, no dramatic sense of arrival. If anything, it feels strangely quiet. Because by the time a trader reaches this stage, they have learned something that most never fully accept. The market does not reward excitement, it rewards restraint. In earlier stages, stimulation was mistaken for engagement. Movement was confused with opportunity. The nervous system learned to associate activity with control. But here, that conditioning begins to dissolve. The trader no longer seeks the emotional high of frequent participation. They no longer feel compelled to prove relevance through constant action. They have learned that dopamine is a poor guide for decision-making. Dopamine demands novelty. It thrives on unpredictability. It pushes the trader toward overtrading, overconfidence, and unnecessary risk. And for a long time, the trader mistook this chemical excitement for intuition. But now, intuition feels different. It is calm, unhurried, grounded. The trader recognizes that boredom is not emptiness, it is stability. And stability is where precision lives. In this stage, the trader becomes deeply selective, not because they are fearful, but because they are clear. They understand that most trades are noise, that most movement is not opportunity, that waiting is not wasted time, it is active discipline. This understanding rewires behavior. The trader no longer opens charts to be entertained. They open them with intent. They no longer feel the need to trade every session. They are comfortable standing aside for days, sometimes weeks, without internal pressure. This is profoundly countercultural. Everything in modern life rewards speed, stimulation, immediacy. Trading communities glorify action. Social feeds celebrate constant activity. But this stage rejects that narrative entirely. The trader chooses boredom over chaos. They accept that consistency is repetitive. The excellence looks unremarkable from the outside. That profitable trading rarely provides stories worth bragging about. And this acceptance is liberating, because once the trader stops chasing emotional reward, performance stabilizes. Trades are placed without urgency. Stops are respected without resentment. Exits are taken without regret. The trader no longer negotiates with the market. They execute and move on. Losses no longer demand emotional recovery. Wins no longer demand celebration. Both are simply outcomes of a well-defined process. This emotional neutrality is often misunderstood. It is not detachment. It is maturity. The trader still cares, but they care differently. They care about execution, not excitement. About risk exposure, not prediction. About longevity, not intensity. This stage also demands solitude, because boredom cannot be shared easily. It does not generate conversation. It does not create social validation. The trader may feel increasingly disconnected from trading culture, from forums, from opinions, from noise, and that is intentional, because this stage requires psychological independence. The trader no longer needs external confirmation. They no longer adjust their behavior based on what others are doing. They trust their process not because it is perfect, but because it is proven. This trust allows for restraint even during tempting conditions. When markets are volatile and headlines dramatic, the trader remains steady. They do not confuse excitement with opportunity. They wait for alignment. This waiting is not passive, it is alert, observant, intentional. The trader understands that the hardest skill in trading is not entry or exit, but non-participation. Knowing when not to trade requires confidence without ego. It requires discipline without force. It requires the ability to tolerate doing nothing while others do everything. And here lies the final paradox. The trader who trades the least often sees the most. They see risk before it escalates. They see opportunity before it becomes obvious. They see themselves clearly without distortion, because boredom creates space for reflection, space for recalibration, space for self-awareness. In this stage, trading becomes sustainable not just financially but psychologically. Burnout fades, impulsivity dissolves, emotional swings flatten. The trader builds a rhythm that aligns with their nervous system. They trade when conditions are right. They rest when they are not. There is no guilt in absence, no pride in presence, only alignment. This stage does not make the trader invincible. Losses still occur, drawdowns still happen, but they no longer threaten identity, because the trader has separated self-worth from outcome. They know who they are regardless of the last trade. This is the deepest transformation of all. The anti-diversification rule ultimately leads here not to restriction, but to freedom. Freedom from distraction. Freedom from emotional dependency. Freedom from the need to constantly engage. The trader has learned that doing less, when done with precision, is more powerful than doing more without clarity. And this is why most never reach this stage. Not because it is complex, but because it is quiet. It offers no adrenaline, no applause, no spectacle, only consistency, only restraint.